Friends, it is rightly said that price is what we pay and value is what we get. I just repeat, price is what we pay and value is what we get. The concept of valuation changes from person to person, organization to organization. It is such a subjective matter, but when it comes to subjective matter, the institute comes into foray and they have brought the valuation standards and making this topic much more objective. Friends, with IPC 2016 coming into play, the concept of valuation and valuation professionals has increased a lot. And to understand why this course was required, I now request the dynamic chairman of the vibrant Nagpur branch, say Saket Bagdia, to please come forward and address the gathering. Over to you, Saket, sir.
Thank you so much, Jitin. A very good morning, respected dignitaries, Chairman of Valuation and Valuation Standards Board, Central Council Member, C. Anil Bhandari ji, Vice Chairman of the Board, C. MP Vijay Kumar sir, my colleagues in the Managing Committee, Vice Chairman, C. Jitin Saglani, Secretary, C. Sanjay Agrawal, the renowned speakers for this important session, C. Sumit Hadda ji, C. Rashmi Shah ji, and the respected dignitaries who have joined this session. A very good morning to all of you. This course was actually thought into my mind because I said that value is what we create. It's not only about that. I'm going just offbeat about the topic. Valuation standards are the thing which is a professional opportunity. We foresee a professional opportunity to this, and that's the reason we thought that we should get this refresher course done. Organized by Valuation and Valuation Standards Board, but hosted by Nagpur branch. It's a privilege for Nagpur branch to host this, and I thank the Valuation Board for giving us this opportunity to host this prestigious event. Value comes when we value ourselves. I'm going just an offbeat because we have got the two most dynamic Central Council members who can also guide the members on these two value words, because whenever these two people say, they always say value is what you create. So value addition, these are the two terms which everybody should now use in our practice with the changing scenarios. This is the new word which is there. We CAs need to value our services. We get what we portray. We get what we command. These two alphabets, the alphabets of trust. I always say that I'm proud to be a chartered accountant because I know what a chartered accountant can do. A chartered accountant always creates value. And that's the reason this course of valuation can best be suited, justified by a qualified chartered accountant only. So therefore, I say that a chartered accountant who is a registered valuer is giving much more value than any other person. As the brand ambassador for this, we are the brand ambassadors of this alphabets CA. So CA, the alphabets of trust. I feel we all are going to have a lovely session on these standards, and everybody will get greatly benefited by the deliberations from the expert speakers all over the country. CMP Vijay Kumar sir, the Vice Chairman of this committee, C. Rajan Wadhwan ji from Delhi, C. Parag Ved ji from Mumbai, C. Drishti Desai, the Vice Chairperson of WRC from Mumbai, C. Tarun Mahajan ji from Indore, C. Sushrit Chitale, the Regional Council Member from Mumbai, C. Sumit Hadda ji from Jaipur, and C. Rashmi Shah from Mumbai. Friends, it's going to be a really interesting session, and I feel that everybody of us will be greatly benefited by the deliberations of this. We'll look ahead to Anil Bhandari sir and MP Vijay Kumar sir to create more value for the professionals in the coming days. Thank you so much. Welcome all of you to this big space. Thank you so much. Over to you, Jitin.
Yeah, thank you so much, Chairman sir. Friends, we have Fire and Ice with us in the form of two Central Council members. We have Fire in the form of Anil Bhandari sir, who talks very well and can set the stage on fire. And we have Ice in the form of MPV sir. He's so charming and he's so cool and calm that he can compose the entire program and the meeting. So, but to formally introduce both of them, I have the honor, and I'll do that. The first in line, I'll be introducing MPV sir. See, MP Vijay Kumar sir is a Central Council member of the ICAI, and he's been there in the Central Council since 2016. He's a Vice Chairman of the Valuation Standards Board and Chairman of the Accounting Standards Board. He's a member of the IFRS Advisory Council 2019 to 21 and IFRS Small Medium Enterprise Implementation Group 2020 to 23. Presently nominated member of the National Financial Reporting Authority and was earlier member of the SEBI on Disclosures in Accounting and Quality Review Board of ICAI. Friends, this is a brief about MPV sir. Please welcome MPV sir with a huge round of applause. Over to you, MPV sir.
Thanks, Jitin. Sincere thanks to Saket and all the managing committee members for the invite. I'm conscious that I have a technical session to address, basically introducing the valuation standards. But nevertheless, I will take this 5 to 6 minutes opportunity of setting the tone for this 4-day webinar training learning session. So greetings to all. Trust all of you are safe and near and dear ones healthy. My sincere respects to the past president, Jaydev Shahji, who hails from this city, which is a very important city for the country for various reasons all of us are aware. Extremely happy that for Anil, it's actually the time to start sleeping. Actually, he's awake throughout the night. And when Sarika said we'll have this program at 8 o'clock, I told her, look, it must be 8 p.m. Be very careful. She said, no, because it's Nagpur branch, Anil sir has agreed. So thanks, Anil. I know it's not part of your routine, but it's always a pleasure to be along with you because the kind of energy you bring to the place where discussions happens is phenomenal. And more importantly, the positivity and constructive kind of thinking you bring in. And for me personally, I've known Anil a little before I came into the council as well. I've seen him always as a champion of change and simplicity. In fact, on simplicity, he and I would have had so many hours of discussion on standard setting, whether it is internal audit or now forensic audit standards. And for me, it's been a learning experience each time I interact with him. And the way he makes his best effort to ensure that the communication is simple is just too good. And I will take this learning with me forever. Thanks, Anil, for that. So let me take this experience to share a few thoughts on valuation. My experience is not as a registered valuer, but as a consumer of valuation services, a trainer on valuation for nearly 20 years, and now as a standard setter. One, I am extremely happy the way valuation profession is maturing. It is a nascent profession, and it is imperative to ensure an orderly growth of the profession. Many tend to equate valuation with IBC, but let me tell you, IBC is a very small component of the total opportunity in the valuation profession. For example, in SEBI, we have REITs, InvITs and all, where valuers are engaged for terms of 4 years and then new valuers have to be rotated out. So there's plenty of other opportunities as well. Second is like taxation. Valuation is a very high economic impact for several stakeholders. And given that it is highly fact specific, involving tons of assumptions, judgments to be made, the competence requirement is very, very high. In my experience, many times, there is a highly conservative approach out of fear of going wrong on assumptions. Conservatism is required, but what is important is ascertaining fair value. Neither conservative nor aggressive. It's not easy for an auditor who has been trained on the principles of conservatism, prudence, skepticism. Giving that a little bit of a go by and determining fair value is not an easy task. Fourthly, with Ind AS, financial statements have embraced fair value to some extent. While many believe there is high use in financial statements, except financial instruments, almost all are at cost. Property, plant, equipment, inventory, receivables, etc. Ind AS 40, the council has approved amendment effective 1/4/2023. The subject is now with MCA, and once that Ind AS 40 is amended, it will allow revaluation model to be followed by property developers, apart from insurance companies. And my view, almost all property developers are likely to follow the fair value model, because the fair value model will truly reflect the operations of a property developer. And that's a big opportunity, effective 1/4/2023. And apart from this, I would expect over time, as the valuation profession matures, many of them will follow revaluation model for property, plant, equipment as well. Revaluation model ensures the users get to know the real worth of the assets. And we all know that property, plant, equipment is a substantial part of assets of most entities. More importantly, the revaluation method ensures a matching concept. Depreciation is measured on the basis of the revalued number. Just like income is based on today's price level, salary, cost of goods sold is on today's price level. Depreciation should be also on today's price level. In an inflationary economy like India, to replace assets for physical capital maintenance. And just a word on COVID impact. Considering the insecurity of the markets, the unclear long-term impacts of lockdowns and limited liquidity to businesses, there is plenty of liquidity otherwise which is chasing the capital market now. It is far more challenging than ever to determine the value of an asset. The use of virtual tools and desktop valuation instead of personal inspections are becoming widespread. Yet there are some concerns about the risk and limitations of lack of physical tools. These include the accuracy of technical tools, as key aspects can be missed out. The valuation profession faces significant challenges as more valuation processes become automated and role of valuer becomes one of data handling and information processing. With this, the role of valuer must change in order to respond to the industry's needs. The role of valuer in particular and how the profession could maintain and increase its relevance needs to be examined. My 2 cents, I repeat, my 2 cents, use technology more for data and value-based judgments. Data with the firm, that is the valuer firm, and data analytics will be key differentiator. I strongly recommend embracing digitalization for customer experience, data collection, data analysis, etc. Most valuations will always be subject to test in future, where the regulators will have the benefit of hindsight. It is hence important that within valuation firms, there need to be a work environment where valuation exercise assumptions are challenged and debated. I repeat, and I strongly encourage this. If you are a proprietary firm, please ensure that there are like-minded fellow professionals where you can actually debate. For every valuation exercise you do, the assumptions can be challenged and debated. And particularly for young valuers, I would recommend unhesitatingly seek a review by experienced valuers, even if you have to share a portion of your income with them and your net income is lesser. So with these few introductory words at this stage, best wishes to this 4-day event, and thank you all for your patient listening. Wish you all a happy learning.
Thank you. Thank you so much, MPV sir, for that composed and subtle address in the very beginning of this refresher course and setting the tone of the course. Friends, as I said, we have fire and ice amongst us, and now it's time to witness the fire in the form of Anil Bhandari ji, hailing from Mumbai, a Central Council member and the chairman of this Valuation Standards Board. Friends, I take the honor to introduce him. Anil Bhandari ji is a Central Council member of the ICAI and he's a chairman of the Valuation Standards Board. He's a certified internal auditor from the IIA Inc. Florida, US, and certified information systems auditor from Osaka, US. He has been the past president of the IIA, that is Institute of Internal Auditors India, and has served on the board of ISACA Indian Task Force. This is a brief about Anil Bhandari ji. Friends, please put your hands together to welcome Anil Bhandari ji. Over to you, Anil sir.
Thank you, Jiten. A very good morning to Nagpur. I think Sumit Dadaji has said that voice is coming fine. So I think somebody raised an issue about voice. So I hope I'm audible. So a very good morning, Nagpur, and I think a fantastic work that you guys have always been doing. A city of oranges, and I truly hope that all our family members are safe there. And as far as I keep hearing, all the work that the team is doing in Nagpur has been fantastic. And of course, good morning to everybody, and a lot of you here on the refresh course today, I know personally. So thank you so much for having taken this interest and being part of this refresher course, because I think it's extremely important for all us to understand the concepts of valuation. And of course, we will talk about the opportunities and so on and so forth as well. I think let me not take you very far. Let me just take you pretty close to what has been happening across the world. And if you were to look at the economic times on a daily basis, you would realize that there's some amazing amount of valuations being created on a daily basis. It's the first time that you see several unicorns coming out of this country, and Zomato has been a fantastic case study. In fact, on our Sunday programs, I'm not sure if some of you are aware, but we hold a program on every Sunday, which is Sundays with Valuation Experts. So I would, of course, encourage you to attend this program as well. I believe valuation, and rightly said by MPV, my friend, who's also the vice chairman, and rightly said by MPV, I think valuation, is no longer, understanding valuation concepts is no longer important. I think it's become a necessity for all of us. It's a strong requirement in the index. It is a requirement in IBC. It is a requirement for issue of shares, transfer of shares under different sections. It's a requirement for income tax and so on and so forth. So while there is a statutory requirement of valuation, I think there is also a very strong business need and requirement of valuation. I think if one would look at the concepts of valuation is also very, very interesting. I think on all of these Sundays, it has been a fantastic learning experience for me, understanding valuation, understanding when do you use DCF, understanding what is perpetuity valuation, what is the beta value, understanding the risk involved, has been fantastic learning curve in the last 6 or 7 weeks that, we have been discussing valuation. I think Institute has taken a thought leadership role in valuation. So I'm not sure if all of you are aware here, this is the first time that the Institute in the last term actually took a thought leadership step. And of course, MPV played a very important role there, that we were the first ones to put up our valuation standards in this country. And not only in this country, I think we are the first few ones across the world to have put a valuation standards. I think other than the international valuation standards, I think that this is the only country, right, MPV, to have put up a valuation standards. And I think the way that we went about setting this valuation standards was also very interesting. We put together a very good team. And I think the way the valuation standards have come out is also fairly interesting. And I think the government has recognized the effort. IBBI has recognized the effort. And I think everywhere that I go to and every program that I go to, all the experts who come in here to either run the awareness program or to either, give lectures on valuation or teach us concepts on valuation, I think a very important element there is the Institute of Chartered Accountants valuation standard. So I would once again encourage all of us here today. Of course, you're going to go through this learning experience, and you have some really very interesting speakers who have come up here. You would get a chance to go through the valuation standards, and that would be fairly important as well. I think at the Institute and at the Valuation Standards Board, while we have covered all of these valuation standards, a couple of things that we are looking forward to do and to come out with new valuation standards, that is professional insights, which has come out. MPV has also authored and helped the Institute put up a concept paper on valuation for startups. And I believe that also is likely to be released by the Institute soon, and it should come out to all of our members. And I think valuation of startups is also a very, very interesting topic. In fact, we had a session on valuation for startups just last Sunday. I would encourage you that the next Sunday is likely to be valuations of brands. And that is also a very, very interesting topic, right? So valuation of brands, valuations of startups, they have a very different connotation. And also what I've learned around all of these programs is that the scope of valuation is very important. Kindly remember, all through your program, the scope becomes one of the most important elements for valuation. What are you actually valuing this for, right? So is that for a sale? Is that for buyout? Is that for share issue, transfer? Is that perspective from an income tax angle? Is it for IBC? I think all of those are very important elements of valuation, and one should actually recognize the fact. I would only want to, of course, not take too much time and come to a very important element that I would have probably understood is that valuation till probably not yesterday, but sometime back, was actually done basis a lot of information provided to us by the management, right? And I would have seen several valuation reports stating that this is as per information provided, taken it on face value and put it through an Excel sheet and generated the magic number there. I think it's very, very important for all of us to understand that it is no longer that you can take all of these management reports that are submitted to you at face value. You would have to review them. You would have to dissect them. You would have to understand the industry. And one thing that MPV was mentioning last Sunday was, in fact, valuation would become more and more trickier. Valuation would become more and more an expert opinion to say about the fair value. That you might have to look at valuation for industry and become a specialized professional offering valuation services for a particular industry. So it could be aviation industry, valuation and understanding that industry could be completely different. It could be telecommunication, completely different. And the likes of Zomato, for example, comes in, it would be completely different. You would need to understand industry. You would need to understand industry trends. And I think that is where, like MPV said, data analytics, understanding where you get that information from is absolutely important. I think valuation of ESOPs, which are likely to become more and more useful in our economy going forward, is again a very tricky subject and a very, very interesting one. And finally, I think valuations has the complexity. When you get into financial instruments, they are likely to get more and more complex. So the short story of the long story is, it's a fantastic subject. It is a very engaging subject. I'm sure all of you would love this. And finally, the kind of opportunity which is likely to come out through this subject is also likely to be very, very interesting, because valuations, registered valuers, they are likely to, I think, as a profession opportunity, likely to keep increasing year on year, because this has become one of the mainstays. And even during an audit, I think valuation becomes one of the most important aspects. So I think with all of this, I would only want to encourage all of us in Nagpur to be able to get onto this awareness program that we have, and also get onto this refresher course that you have. And finally, if you believe that this is an area of your subject, I would encourage you to get to being a registered valuer, because I think the tremendous opportunity is available for all of us here. And especially because we are working from home, it no longer matters whether you're sitting in Nagpur, Mumbai, or Delhi. I think the opportunity comes on the table as MPV has put this across. So thank you, Saket and Sanjay Bhaiya, for setting this program up for the Nagpur city. I think it's a fantastic program that you have set through, and I think I'm really encouraged by the number of people who have decided to take this refresher course. And I hope you have a very, very engaging day today and all the possible sessions that you have. And one thing for sure, in MPV, you have a teacher, a professor, a mentor that you would never get for these kind of refresher courses. So I think you're really lucky to have MPV. Forget about myself coming in the morning here. I think you're really, really very lucky to have MPV here, because when he teaches, I think you don't forget. And that is something that I do. For example, I learn from him every Sunday. And I've heard that the students in South, when they meet up with MPV and shake his hands, they don't take baths for the next 10 days. Yeah, that is the kind of fan following that MPV has. So I must tell you that you're really lucky to have him here. He is one of the, how should I put it? Of course, we are all friends, but I think if there is somebody that I look up to in the institute, that I think MPV would be one such person that I would look up to in the Central Council. So I think you have a fantastic person there, a gem of a person. And I'm also sure you have a fantastic teacher here today, a guide, a mentor here today. So thank you once again, Nagpur. And back to you, Chairman Saket. Or Jiten, whoever is.
Thank you so much. Thank you so much, Anil sir, for emphasizing 3 areas that this valuation course is fantastic. It's engaging and it is providing more of the opportunities to be professionals. And thank you so much, sir, for sharing the insights of what Institute is doing on this front. It was a very nice deliberation by both of you, MPV sir and Anil Bhandari sir, on this occasion of inaugural session of the refresher course. I now invite the chairman, rather the secretary of the Nagpur branch, CA Sanjay Agrawal ji, to propose a formal vote of thanks for this inaugural session. But before that, I also wish to recognize the presence of Sarika Singhal madam, who has joined of late, and she's here. So thank you so much, Sarika ma'am, for connecting. Over to you, Sanjay.
Before Sanjay goes, I will just say that this concept of morning 8 to 11 is the thing with Nagpur branch initiated. And I don't know how many people really liked it, but I feel we thought that this is the best time when you can, because the mind is the most receptive in the morning. This is what we feel. So morning 8 to 11, while doing your breakfast or anything, you are done with your learning as well as what you wish to learn, wish to get inside your body. So
no, I think it's a fantastic thing. I think early morning, people are really glued onto it, and then they can probably get onto their work as well. So I think Saket, I'm sure this is working for you, and Nagpur is always hungry for knowledge, is what I remember of Nagpur. So I'm sure all of you here would really enjoy this. Yeah, like I said before.
Thank you, Jiten sir. At the outset, I thanks to Chairman of Valuation Standard Board, ICAI, Central Council members, CA Anil Bhandari sir, for giving the opportunity to host the important course. I also convey my thanks to Anil Bhandari sir for gracing the occasion and sharing your ideas on the opportunities as a valuer for the CA members. Thank you, Anil sir. I convey my thanks to Vice Chairman of Board and eminent speakers of first technical session, CMP Vijay Kumar sir, for gracing the session and sharing the ideas on importance of the valuation course with us. Thank you, Vijay Kumar sir. I also convey my heartfelt thanks and gratitude to all the speakers of the 4-day course, CA Rajan Wadhwan sir, CA Paragwet sir, CA Drushti Desai ma'am, CA Tarun Majan sir, CA Srusu Chotle sir, CA Sumit Dadda sir, and CA Rasmisha for giving his consent to be as a speaker of this course. And at the last but not least, I thanks to all the participants who participate in this course, and I wish all the best to all the participants as a happy learning course for all of you. Thank you, sir. Over to you, Jiten sir.
You're on mute, Jiten.
Yeah. So friends, without say putting more time now, we will move on to the say technical sessions, and I'll now hand over the proceedings to the chairman himself, who will be taking charge and guiding us all through the technical session. Over to you, Chairman, sir.
Thank you so much, Jiten. It's always a privilege when you get the chance to lead the technical session, and when there is MP Vijay Kumar sir. Sir, I request MP sir to please take up the first topic, overview of ICAI Valuation Standards 2018, distinguishing features of ICAI Valuation Standards 2018 with international valuation standards issued by IVSC. Over to you, MP sir. Thank you, sir.
I'm Saket. So I'm so happy that we concluded the inaugural exactly in 30 minutes as planned. I will also try to stick to my 1 hour and try to finish the presentation on dot at 9:30. Very happy to see other faculty members of the refresher course also joining the inaugural and being present here. My greetings to all of them who have joined here today. So as far as the this particular 1 hour is concerned, I've been invited to share a quick insight into the ICAI valuation standards. And in this context, what I intend to do is give you an idea of how the standards have evolved, why ICAI went about issuing this valuation standards, a quick comparative study with the corresponding international valuation standards because the Companies Act section 247 gives the choice of following any recognized set of standards globally. So it's important to know a quick comparative study with the corresponding international standards. And as part of the ICAI valuation standards, we have essentially 10 documents, 2 parent documents and 8 standards. I'll briefly introduce each of them. A small caveat, whatever views I present over the next 50-55 minutes, all of them are my professional views and my understanding of the subject. They should not be viewed as views of the Valuation Standards Board or any of the other committees of the institute, which I am part of. So as I told you, I'll first spend a few minutes setting the context, then the structure of valuation standards, comparison with the international standards, and the 8 standards which we have. And we have classified the standards broadly into 3 categories. Like in audit standards, you have the 200 series, 300 series, 400 series and all. Here also we have a 100 series which deals with principles of valuation, 200 series which deals with work actually done, and 300 series which deals with valuation of the assets. The figures you see in brackets are basically the number of slides for each of those topics for discussion. Just setting context, I'm a strong believer on what is spelled out here in this slide, which I assume is visible to all of you. I would like to highlight 2 things in this. One is, in today's context, valuations are an integral part of financial statements. It's been there earlier as well, but it has gained far more importance now than ever. There's a inventory valuation, NRV, receivables valuation after considering impairment, financial instruments valuation, particularly if you are in days, there are a lot of guiding principles. And as I mentioned in the inaugural session, there would be property developers who would start following the fair value model, which will be allowed. And over time, maybe next 5 to 10 years, many companies will look at property, plant, equipment also being valued based on the revaluation model. Whenever M&A transactions happens, whenever there's an acquisition, there's a merger, the consideration, determination, and allocation of consideration to individual assets, what we popularly call as purchase price allocation, that determines your depreciation or amortization methodology, etc. as well. So it's become such a very integral part of financial statements. And financial statements, whether as a preparer or when you express an opinion, financial statements are a communication, and any communication needs to be only truthful and complete. The background for ICAI to have come out with this valuation standards, and it's something we need to be proud. I think many times people have some critical observations, but I believe when people have critical observations, it is because they believe much more performance can be done and they would like to contribute in that direction. In fact, while valuation has so much of discussions now, the institute started a course on valuation and building competency on valuation way back in 2008, much before the valuation profession got recognized in law. The valuation recognition in law has just come, which is 3 years old, but institute has its efforts in building this profession right since 2008 when we used to run the certificate courses. And the institute has also been working over the last decade on developing these standards, but it required a legal push, a regulatory recognition for it to get more acceptance. With Ind AS coming in, where there is a fair value acceptance which is pretty high, the existing accounting standards which are notified under Companies Act for non-Ind AS companies or by Institute for non-company entities, these existing standards are now being revised, and most likely from 2024, you would have a fresh set of accounting standards which will be almost close to Ind AS. So when you have those kind of high quality financial reporting, valuation becomes even more important. There are requirements in various legislations. Companies Act has a long list of sections where valuation needs to be done only by a registered valuer. There are requirements under Income Tax Act for valuation, FEMA, SEBI, there are valuation requirements for real estate investment trust and infrastructure investment trust. So there are valuation requirements spelled out there as well. The profession is just exploding beyond IBC. And as many of you must be aware, there's the draft valuers bill, which has been exposed to the public and which should take the form of an act sometime soon. There's a huge increase in private equity transactions. We all know the startup ecosystem and the number of unicorns which have come up within a short time within India, and the potential larger number of unicorns which are likely to come out of India. All of those, right from seed funding, there is a valuation. So seed funding, Series A valuation, and continuous inputs of capital coming in. The founder is willing to dilute his shareholding to as low as 30%, 20%, 10%, and keep raising capital for overall organization build. And many of you may be aware, SEBI has issued a consultative paper in 2019 for differential voting rights, what they call as special voting rights. In the special voting rights, what happens is, if I am a startup founder, I can ensure that my shares have a voting right, which is far higher than the voting rights of the other shares, as long as I continue to be a founder. So in that context, so if I am a founder, even if my paid up share capital amount is only 10%, my voting rights can be 5 votes per share, which effectively means for a 10% economic capital, I can have voting rights as high as 50%. So SEBI is in the last stage of finalizing those rules. So there's so much of activity happening around valuation, around this system, that valuation profession will become much, much more important than ever. As a valuation standards board, we have 4 objectives which are listed down in the terms of reference, and every activity of valuation standards board is towards these 4: formulating standards, propagating valuation standards so that people can accept the valuation standards. The quality of product should be such that people should prefer to use ICAI standards in preference to others. I am a strong believer of market competition, and when there is market competition, the best comes out. No competition, we end up with mediocrity. I am very open to a situation where people have a choice of a couple of alternative sets of standards, and ICAI standards should qualitatively stand out ahead of the rest of the others. So we will continue to propagate and persuade concerned parties to adopt them in preparation of valuation reports solely based on the quality of the product then give interpretation and guidance on various issues arising from the implementation of valuation standards so that there is a consistent application of standards. And lastly, review these valuation standards on a periodical basis. I'll just take you through the simple time chart in brief. It's important for you all to know the process which has gone through, because my view in standard setting in particular, whether it is IFRS or Ind AS or internal audit standards or forensic standards or valuation standards, what is extremely important is the process followed in standard setting. The process followed in standard setting is very important, and that is what brings robustness to the standards. That is what brings robustness to standards. And it's important all of you should know this so that your confidence in using the standards and propagating the use of the standards will also be better. So it initially started off in 2016, and for your information, the first meeting, or what I call in South as the Ganesh Puja of the valuation standards, actually started in the office of Anil Bhandari ji. We started in his office, and given the success of having started in his office, I somehow feel any new initiatives we should do the groundbreaking only in Anil's office. So it's been a very successful journey. We had a set of valuation experts appointed, and the initial thought process was we will follow the IVSC, International Valuation Standards, and just like in days, we'll do some edits and issue standards in India, but our discussions on copyright were not successful. So at that time, the Ministry of Corporate Affairs advised us, look, the international standards are also relatively new and they're yet to get global acceptance, and Institute has enough standard setting capability. Why don't you start formulating the valuation standards? So at the nudge of the government, I should say, we started forming the valuation standards. And for this, the Valuation Standards Board was constituted by the then president, a very forward-looking leader, Mr. Nilesh Vikamsi. So he constituted this Valuation Standards Board, and over time, we had multiple meetings and eventually prepared the valuation standards and gave for exposure draft for comments. We conducted a series of webcasts. Approximately 5,000 attended each of the webcasts where we discussed the 8 valuation standards. We did 4 webcasts, and on an average, 5,000 attended each of those ones. All the comments were considered. The standards were finalized and then placed before the council at the 375th meeting, and it finally got approved. Just for your benefit of understanding, globally, we are the only accounting body who has a valuation standards board within. Otherwise, most cases, they are all independent valuation bodies which are there. We have the IVSC, Appraisal Foundation, Royal Institute of Chartered Surveyors, CFA institutes, they have a American Society of Appraisers and Canadian Institute of Chartered Business Valuers. Now, as the Valuation Standards Board, the constitution, all of that stuff, I talked to you. The formation of the Valuation Standards Board. Important to know the composition of the board. The board has about 9 council members, and apart from that, we have nominee of MCA, representatives from various government arms, CBDT, RBI, SEBI. Apart from that, industry bodies like CII, IIM, etc. Subject matter experts, about 5 of them are co-opted, and we are open to having representatives from any other valuation body as well. The approach in drafting the valuation standards was to bring the best valuation practices which are globally followed, and also look at the practices in India and bring them together. Also consider the uniqueness of Indian conditions, more particularly the fact that it is a fast developing economy and not a developed economy, and also that there are lots of expectations from the government on various aspects. So considering all of this, we drafted this valuation standards, and happy to share with you that these valuation standards, we got it vetted by valuation professionals in US and UK, and they had given their observations that these standards have been drafted exceptionally well. And like all other standards, these standards are principle based and they are not intended to be rule based. I am a strong believer that standards should always be only principle based, because the moment you prescribe rules, people will start working around those rules. So principles should be such that based on facts and circumstances, the professional will apply judgment and apply the principles for each fact and circumstances. We also agreed that wherever required, we will develop education material or guidance note in future. This is about the webcast which we did. I'm really very thankful to the branches who had conducted study group meetings and gave comments. And we overall got about 200 comments on the 8 standards, and all of those comments were debated comment-wise, and wherever we found it necessary, we incorporated it in the standards. Now, as I mentioned earlier, the Companies Act has this requirement that registered valuers, while doing evaluation, needs to follow the valuation standards, which will eventually get notified under Companies Act. Sometime it will happen. I can't predict whether it will happen in 12 months or 24 months, but at some time, valuation standards like accounting standards are notified under Companies Act. Valuation standards will also get notified under Companies Act sometime soon. Till then, as a transition provision, the law allows following either internationally accepted valuation standards or valuation standards adopted by any registered valuer organizations. And almost all chartered accountants and majority of registered valuers are registered valuers from ICAI registered valuer organization, and every valuer with ICAI registered valuer organization needs to follow only the ICAI valuation standards. And friends, as you might be aware, valuation for property, plant, equipment, that is including machinery, currently at the institute we took a decision that we will not develop those standards. Whenever the ministry asks, we will do it. But given the recent development of the amendment to the CA Act allowing multidisciplinary practice, I would strongly encourage bringing property valuers, plant and machinery valuers into your firm as multidisciplinary practice. So your valuation profession inside your firm, you will be able to do in your own signature financial assets, partner of your firm. You can do land valuation, you can do plant and machinery valuation. I am sure that will give you a head start in terms of the professional opportunities which come here. And friends, as Anil mentioned, maybe I'm deviating a little, but I don't want to miss this opportunity of telling you. As Anil mentioned, in today's context, the place where you are located does not matter. Even if I am in Mumbai, Mumbai, sitting in Thane. My client is in BKC. I am not going to visit physically. Clients are used for remote working. So whether the client gets a valuer based in Thane or Airoli or Vashi or based in Nagpur, it doesn't matter. For the client, it doesn't matter. He only wants somebody who understands his industry better and can apply the right kind of judgments. So the physical location just does not matter, including for valuations of property, plant, equipment, given the kind of technologies of Google Maps, data available on the net of locations, and use of drones, etc. It just doesn't matter. My view, the next 10 years belongs to those practicing in Tier 2 and Tier 3 cities, for the reason that the amount of time you have and the knowledge all of you have sitting in that market with the communication technology, applicability, as I mentioned, for valuation reports which are issued under Companies Act by members of ICAI, RVO, they all need to follow only the ICAI valuation standards. And for chartered accountants who issue valuation reports as a chartered accountant, not as a registered valuer, So those cases, it is recommendatory status, but I would strongly encourage, and I'm sure the speakers who will speak over the next 4 days, Rajan, Sumit, Rashmi and all, will speak about their experiences of how they have benefited from use of the ICAI valuation standards, and you can openly question them on the quality of ICAI valuation standards vis-a-vis the other standards which are available. As I said earlier, I strongly believe in a highly open competitive economy, and it gives the best of the product. And given the fact that a member has a choice of ICAI valuation standard and others, the product is qualitatively superior, and hence I strongly recommend use of the ICAI valuation standards. And under the Companies Act, this slide and the next slide give a list of the various provisions where valuation needs to be done only by registered valuer. For example, issuing shares for consideration other than cash, issuing sweat equity shares, issuing shares on preferential allotment basis, or giving money for purchase of shares by a trust, buyback, so on and so forth. M&A transactions, corporate debt restructuring, purchase of minority shareholding, squeeze out of minority, all these cases, you are required to follow or required to do it only by a registered valuer. Now, coming to the ICAI valuation standards, these are the 10 documents issued by the Institute. The first two are parent documents, preface and framework. The next 300 series are principles, 200 series are about work and reporting, and 300 series deals with individual asset classes. So as far as these standards are concerned, these 10 documents in brief, the preface talks about the Constitution of Valuation Standards Board, its procedures, function, scope, and how the standards are to be issued. The next document is very, very important, framework. Framework is the mother document. It is mother document because if something is not available in the individual 8 standards, you should refer to the framework, which will set down the concepts and the principles underlying the preparation of valuation reports. ICAI Valuation Standard 101, we decided to have one separate standard exclusively for terminologies used across all the valuation standards. So all the terminologies used in various valuation standards, you will find in one single standard, which is 101. 102 is a very important standard. I'll spend time in detail a little while from now. We have what is called valuation basis. There are 3 valuation bases and 5 valuation principles. I'll walk you through one slide little while from now. And for any valuer, any valuation exercise, the starting point is choosing the valuation base, premise, approach, method. Base, premise, approach, method. These 4 needs to be chosen. And your skill set in selecting this what matters. Your skill set in selecting these is what matters in this entire valuation. Then 103 talks about valuation approaches and methods. 201 standard talks about engagement letters, analysis to be done on the information which is available for valuation, responsibilities of valuer when he is relying upon the work of other experts. For example, I am doing a business valuation, let's say for IBC, a liquidation valuation. So when I do that valuation, I rely on valuation report of a property valuer because I am not licensed to do. So I will rely on a property valuer, plant and machinery valuer, and incorporate his number in my valuation report. So when you incorporate another valuer number in your report, there are some responsibilities casted. You can't treat it like a commodity and say, whoever value registered property valuer is there, let him, whoever is a low cost, I'll take his number and put it. You cannot do that. There are certain responsibilities cast, how you should select an expert and how you have to rely upon him in terms of bringing your valuation. Next, coming to valuation standard 301, these are the 3 individual standards, and I will, just for the benefit of the participants here, a copy of the slide deck, I'll leave it with Saket for sharing it with you later. So 3 asset classes, we have separate standards. One is business valuation. It gives guidance on how to do a business valuation assignment. There can be some cases where the transaction is for 100% acquisition, transaction is for majority acquisition, transaction is minority acquisition. So there are principles given, guidance given on how to handle each of those. Then 302 deals with valuation of intangibles, copyright, brand, franchise, goodwill. So how do we go about valuing? 303 deals with valuation of financial instruments, whether it is shares, convertibles, optionally convertibles, bonds, perpetual instruments. So guidance is available for valuation of all of those in the standard 303. I will speak about these 8 standards in little detail few minutes from now. A snapshot comparative study of the IVSC, International Valuation Standards, and ICAI Valuation Standards. I'll just highlight the differences. One, the ICAI Valuation Standards does not cover property, real estate, and plant and machinery. It was a conscious decision of the Council of the Institute. We did not want on an area where we do not have expertise to develop those standards, except that use our standard setting experience if MCA wants, by involving relevant subject matter experts. So at this stage, these 2 are not covered by us, whereas internationally, those 2 are covered as well. In our standards, we have allowed, or rather recognized, that in some circumstances, For determination of a value, we may have to follow multiple valuation methods and use weightage to arrive at the value. IVSC standards prefer use of only one method, while ICAI valuation standards also prefers the same. It does not discourage from applying in certain situations valuation to be done by a combination of methods and arrive at a weighted average, and we have given guidance on how weighting should be done and weighted average is to be determined. IVSC provides that only one value is to be given, and in our case we have said we can also give a range of valuation. So recall any public issue of SEBI guidelines and all, you have a valuation range 70 to 80, 70 to 75 range. So we recognize that it is a point of negotiation between buyer and seller as to where it will settle down. But as a valuer, there could be certain situations where you may actually prefer to give a range of valuation between 300 million to 320 million. I may give a valuation range. So our standard allows it. There are many jurisdictions also which allow the same. Valuation basis, we have 3 valuation bases which I'll spend time on, and we have not defined market value as a base because we believe fair valuation is representative of a market value. We also recognize the concept of relative value. Information to be obtained by valuer, IVSC standards as a very simple requirement of reasonable and sufficient information. We added additional guidance on what all information needs to be collected, including non-financial information, ownership details, etc. This is an important one. The international standards require investigation to be done, whereas we debated substantially. There's a huge amount of debate, and finally we agreed that what we can do is only an analysis of information. For those who are already exposed to valuation, you'll all recognize that most of these valuations are actually desktop valuation, which means you sit on your laptop, use that huge amount of data available and the experience and knowledge of the industry you have, and start forming judgments on the information which you have collected and use it for valuation. An investigation would mean that you should go very deep, and we did not want to bind our members to a requirement of investigation. Investigation would mean you have to do something more than an audit. We all know when you do valuation, you are relying on audited financial statements. Audited financial statements are not based on investigation. They're not based on investigation. So when I am relying on audited financial statements, if I have to do investigation, then I should ignore the financial statements and go deeper into all of the information available. So we decided that the valuer can take responsibility only to the extent of analyzing the information available and cannot get to a state of investigation. So that's one major difference between their standards and our standards. Valuer signature, we have prescribed certain requirements of identifying the valuer. Many valuers will actually have a valuer entity. Like I may form X Private Limited, who is the registered valuer. So if I'm signing as X Private Limited, then there's an entity identification also to be done. Now, coming to this 8 individual standards, 101 deals with definitions, as I mentioned to you earlier. About 48 terms have been explained. 102 is a critical standard. And all valuation exercises actually start with this particular standard 102 and then 103. Recall, I told you 4 things are responsibility of a valuer. Identifying the right valuation base, premises, approach, method. These 4 things I have to choose. For me to choose, I should know what are these things. And then I should know what is the criteria based on which I can choose it. So this standard defines the important valuation basis, prescribes the approach in terms of how valuation base is to be selected, explains the premises of valuation, and how do you go about selecting the premise. This is an important slide before I go to the next one, which deals with the 3 bases and the 5 premises. This standard does not apply where a valuer is required to adopt a valuation base if it is prescribed in law or in an agreement between the parties. For example, there can be a case where between the buyer and seller, they decide that valuation is to be done using a participant specific basis. Those cases, I should follow only that one. Similarly, if we take section 236 of Companies Act, squeezing out of minority interest, those cases only fair value is allowed, nothing else is allowed. So some cases statute tells do this. Then there is no need for us to apply mind. We just follow what the statute says and disclose it in your valuation report. As to why you took this, it is an arrangement between parties that will follow only this basis. Then disclose the same also in your valuation report that I selected this basis not because I thought it is good. I took it because the parties concerned agreed that they should follow this particular basis. Now, what are the 3 valuation bases and the 5 valuation premises? Valuation basis can be fair value. Majority of cases it is fair value. Second is participant specific value. That is, if I am a person who is acquiring with a particular intent, I have certain considerations. So those considerations I will include. For example, the fair value of, let's assume your house, adjacent land is available for sale. The fair value of that land can be 50 lakhs. But for you, let's assume 2 children. I want to give current house to 1 child. And I want to build 1 more house, give it to other child. So for me, the value of that land, I am ready to pay 60 lakhs also. So fair value is 50, but a participant specific consideration, I am ready to pay extra 5 lakh, 10 lakh. That is called participant specific valuation. Then liquidation valuation, like what we have in IBC and all, we are also required to give. On a going concern, this is the value, but let's assume it is shut down. Assume it is shut down, what is likely to be released? That is called liquidation value. So every valuation exercise, valuer has to choose one of these three. Fair value or participant specific value or liquidation value. Then 5 valuation premises. The premises are, one is called highest and best use. For example, continuing the same example of adjacent land near your house, adjacent to your house. For constructing it as a house, it has a value. for constructing it for a commercial purpose. It's a corner plot. The corner plot is a main road. My child may tomorrow want to have an office space there, whatever. So there is an alternate use also available. The best use I can put it is a commercial usage. So for me, constructing house is my objective, but when I do a valuation, the highest and best possible use of that asset is one premise. Another is on an as-is where-is basis. Today on that particular property, there's a workshop. I also want to continue with that workshop. So on an as-is where-is basis, what is the value? Going concern. So if this organization were to continue, given the market, the future growth rate, etc., I am ready to pay for that future growth rate. How much is the value? Orderly liquidation. I am in no hurry. There is a small scale unit which is there for last 30 years, but now no succession planning. My children have gone into information technology industry. They are settled in Bay Area, New York, or SFO. So my SME, I built this business last 30 years, doing reasonably well, but I am not likely to find a buyer with all this COVID, etc. I want to orderly liquidate it, sell off some machinery, sell off stock, sell off land over a period of time. There is no hurry. The other premise is forced transaction. I am already above 70. My health is fragile. I just want to go and be with my children. Maximum 3 months, I want to leave the place and move on. So a forced transaction, I want to exit. Or there's a change of pollution control law, environment law, which says you're done. You can't do this business anymore. You have to exit it. So those are all forced transactions. So you need to select one of these 5 premises as well, based on the valuation engagement when you go for a valuation exercise. Now, so while doing all this, the valuer is responsible for selecting it, and there is a guidance available on how this is to be selected. Now, coming to valuation approach 103, there are 3 approaches available for valuation. And as I said earlier, the valuer is responsible for selecting the approach. At the cost of repetition, 4 things are responsibility of valuer. 4 things: basis, premise, approach, method. Now, as far as the approaches are concerned, we broadly have 3 approaches: market approach, income approach, cost approach. So market approach is an approach where you try to arrive at a value based on the market related information. Like for example, your individual house, you are currently in a house, there's an adjacent land come up for sale. You know 3 months back, the land opposite your house got sold for 48 lakhs. So in those cases, the valuation is largely determined by what's happening in the market. In the market, guideline value, actual transactions which are happening. So that will give you the guidance on how do I value the asset. That's called market approach. Same thing is applicable for business also. When I value instrument, financial instrument, or I value a brand, or I value a company, similar company got sold at 15 times EBITDA. So that is an indication that market is ready to pay only 15 times. No matter what I do, the market ecosystem, the number of buyers, sellers, there's something which has evolved. That's a market approach. Second is called income approach. So in an income approach, we are basically looking at for this asset, asset can be machinery, can be a company, can be an intangible, can be a financial instrument. For this asset, what is the income? And based on the income, I'll determine the value. income methods can be discounted cash flow method, which is very popular for valuing businesses. Relief from royalty method, very popular for valuing technology assets, intangibles. Multi-period excess earnings method, where you have some of your intangibles where without intangible, with intangibles, how do you valuation? So there are all of these income-based approaches. Last is cost approach, where you have an existing asset. If you have to replace the asset, how much will it cost? There's a 7-year-old asset. If I replace, how much will it cost? If you have to build a similar asset, how much should it cost? Those are called cost-based approaches. So you have to decide among the 3 approaches, what is the best approach for the asset you are now valuing, And you should have your working paper. You should have your working paper which should tell why I am selecting this approach and not the other 2 approaches. Within that approach, which of the methods I am following also I need to decide. And that again, you should have a working paper for the same. So broadly, these are the approaches. But please note, these approaches, 3 methods in market approach, 5 methods in income approach does not mean there are only 3 methods. Does not mean there are only 5 methods. These are the most commonly used methods in the market approach, commonly used methods in the income approach. So as the profession evolves, if there is a 6th method in income approach, you are at liberty to follow it. That's why these standards are called principle-based standards. Principle-based standards. You can follow a 6th approach as well, 6th method as well. So as a valuer, you need to decide on which of the 3 approaches and thereafter the methods. And for it, and that's the responsibility. Look at this slide. That word responsible is in red font. That responsibility is of the valuer now. And it's not an easy decision to make. You require a deep understanding of the industry for you to decide what would be the best approach to be followed. And this decision, several criteria are there. Let me highlight 2 criteria which are in underline. One, the approach and method. One of the key determinants which tells you I can follow this approach, I can follow this method, is the availability of adequate inputs or information and its reliability. For example, suppose I am valuing a startup which is in a space exactly same as Zomato, Swiggy, then there is enough market information on what is the comparable transaction multiples. But if I am valuing a startup in some niche technology for which there is no comparable transaction available, those cases I cannot go on market approach. I will have to look at the income approach. So you need to look at the availability of inputs and information and the reliability of the same. That's one key guiding factor. The second key guiding factor is what is it which is generally considered by market participants. So that's why, as Anil was also mentioning, as a valuer, you should be continuously glued to every transaction happening to find out for this transaction what was the approach and method. You should build your library. On these are all the 20 transactions which have happened in this particular pharma industry, in this particular beverages industry. And for this beverages industry, these 20 transactions, this is how the approach and method has been chosen. So I cannot follow something different from what these 20 guys have done. So you should keep your research base continuously updated if you have to do a valuation exercise. I want to caution again, and I recall Sujal Shah, one of the subject matter experts on valuation speaking in all the programs as well. And I'm a very strong proponent of this. In valuation, the strength of a valuer is the amount of data he has about the industry. And it is that data of the industry transactions and the industry, what should I say, the profitability metrics, industry future. Only based on that, the valuer will be able to do a competent job, and that's extremely important. Now, selection of approach. So valuer can decide which approach to be followed. Where he is following multiple methods, weighted averaging is allowed. But suppose you are following multiple approaches and the range is very high. Like in one method, I got a valuation of 150 million. Another method valuation is 400 million. Those cases, you cannot do a weighted average. Those cases, you cannot do a weighted average. You have to review those approaches once again as to whether both are still relevant or is it one of them. So you have to do it. And any method or approach you choose, one guiding principle, look at the last point. Look at the last point, underline the portion. One guiding principle, which is also there in Ind AS 113, is maximize the relevant observable inputs, which means the maximum number of assumptions you take should be from the public domain, which are all observable by third parties as well, and minimize the use of what is unobservable. So that's a very important guiding factor in the choice of the approach and method. Then 201 on the work to be done. So this is documentation of whatever work we do. Broadly, 3 categories of engagement. I want you all to have a clarity on this. One is somebody appoints me to do a valuation. I do a valuation. That's one. Second type of valuation is like in medical profession. For example, let's say I got a medical checkup. I go to another doctor for a second opinion. Valuation also, a company can go or a person can go and get a second opinion. That is called fairness opinion. Like for example, Saket might have done a valuation and the client may tell, I will go to Jiten and ask him to also review it, get a second opinion. That's called fairness opinion. The standard and law recognize that. The third is valuation review, like a professional review, peer review. And the IBBI, which is the regulatory body, requires peer reviews to be done. Like for example, if Saket has done a valuation, Dinesh Chawla, he may come and do a valuation review later, a peer review as to whether you have done your valuation report properly or not. Or Sumit will come and do a valuation review and say whether you have done your work properly or not. So that valuation reviews will also happen. So broadly, 3 types of valuation engagements will happen. So engagement letter, and the letter should capture among various things, all of this. I'll highlight 2 things alone. Details of users of valuation report. Valuation is always client specific. So always spell out who will be the user of valuation report. Second is, if you are engaging a third party expert, capture the fact that I will engage property valuer, plant and machinery value, capture, and your responsibilities, limitations, all of that you capture in that letter. Confidentiality clause and analysis of information. And whenever you rely on public domain, common mistake. While information from Google search is good, I'm sure many of us know when it comes to medical profession, You can't look at Google information and start prescribing medicines for you. That won't work. Same is true for valuation also. Valuation also, public information, just because it comes in Google, you can't take that and do your valuation exercise. No. It is the responsibility of valuer to satisfy himself or herself that the information in public domain is credible and reliable. Credible and reliable. So you cannot tell, I picked it up from public domain, it will not work. It is the valuer's responsibility to ensure that he is convinced on the credibility of what is there in public domain and that the same is reliable. That responsibility is with the valuer. This is again important. I'm just coming to end. I don't want it next speaker's time. Subsequent events, we always have what is called as a valuation day. Let's say today I'm appointed as a valuer on 25th of July. Valuation based on 31st March 2021. Between this period, some events might have taken place. I should not consider those events. I should consider events only which give additional evidence of condition existing on valuation date. If there is some subsequent event which you believe alters the foundation, like for example, I'm valuing a business on 31st March, which has 3 factories. Unfortunately, 10th of June, 1 factory got destroyed by fire. 31st March, all 3 factories were there. But 10th June, 1 factory is gone. And today I am signing on 25th July. I should recognize the fact that this factory got destroyed. I should make all those disclosures in my valuation. So this is about other guidance which is available, reporting and all. So I've given you broadly an essence of how these valuation standards need to be read through. It's a very involved topic. Apologies, I could not complete all of these standards, but I'm very conscious that I should not eat into the next speaker's time. I will leave a copy of this deck with Saket, and I'm sure he'll share it with all of you. And good thing is we have some excellent speakers lined up for these 4 days. I'm sure they will be able to clarify to you any practical doubts you might have on the topic. So thank you all for your patient listening. Sincere thanks to Anil, Sarika, Rakesh, and the branch led by Saket for the opportunity to be here. Stay safe, stay healthy, stay accountable. Thank you all.
Thank you so much, sir. It's really a pleasure. It's always unending when we listen to you. We really don't want your session to be ended at any point of time. This is the thing, and therefore we always cherish these sessions. But thank you so much, sir. I feel all of us have been really enlightened by our deliberations. Before I request the speaker from New Delhi, Rajan sir, I would request Sarika Singhal ma'am, the Secretary of Valuation Standards Board of ICAI and as well of CLN CTC Committee. She's also the CEO of ICAI RBO to share her thoughts for the benefit of the participants. Over to you, Sarika ma'am, please.
Good morning, all of you. MPV sir, you have chosen the right topics to be left, right standards. 301, Drushti ma'am is there. 201, 202, we have Sushrut sir. And 302, we have Rashmi ma'am, who were part of the group which formulated first draft of the standard. So MPV sir has rightly chosen right standards not to be elaborated. He knew about that we have experts over here to explain these standards. Good morning once again. I would only take 1 or 2 minutes because Saket sir wanted me to brief you about a few things. As we all know that 2017 IBBI was set up as a regulator. I will start with 2016 when this Insolvency and Bankruptcy Board of India came into force and became a regulator for Insolvency and Bankruptcy Code to 2016. So they started regulating the profession of insolvency professionals. Then once this insolvency profession came into force and the companies started going into CIRP and resolution processes started, a requirement came of the valuation. So there is a requirement of valuation by registered valuers by two professionals, and 247 which came into force, which did not come into the force, but it came in the statute book in 2013. It also spoke about valuation to be done by the valuers himself. So in that regard, what happened, IBBI went to the government and they requested the government that please do something. We want a regulated profession to be into force to do valuation, so that credibility is there for this important value the valuation profession. So that is how it came into force, and registered valuer 2017 it came. ICAI with the conscious decision formed this ICAI Registered Valuers Organization in 2018, which is an independent sectionate company formed by institute and is a regulator. As I can see, most of you are registered valuers. So only 1-2 points I would like to brief upon here and would like to request. There are stringent rules and regulations posed by IBPI, which are part of companies' registered valuers and valuation rules. It is a new regulator, and how strict it is, we all know. So whatever are the requirements which are posed on you, please follow the guidelines. There are 2-3 things which I am following up with valuers, but many of them do not follow. Filing of half-yearly monitoring report, which is filed within 30 days of close. When half year closes on 30th September, this report has to be, 15 days. It has to be filed up to 15th October of the assignments. There is a format. And for the half year, it is not yearly, half year. For the half year ended on 31st March, timeline is up to 15th April. Also follow, do not accept assignments if you are registered with financials or securities asset class. I think I need not explain the asset classes with you. There are 3 asset classes as we all know: plant and machinery, land and building, and financial or securities asset. So chartered accountants are eligible to undertake financial or securities asset class valuation. Do not accept any assignment which does not fall under this category. Most of the speakers we have are of the educational course, 50 hours educational course. So they may explain you the process again. And one more thing, if any of you who are not valuers, firstly, you have RBO, which is a separate entity, has already informed to you. Then 50 hours training, after 50 hours training, then an exam has to be cleared, and then you become, after registration, you become registered valuer. So this is the process. One thing I would like to again tell you, we have come out with the VCM ATQs, which is answer to the questions. Lot many questions have been raised by the valuers, the professionals who have attended these VCMs on all the weeks. We have completed 10 weeks. 6 ATQs are already available on ICAI website as well as ICAI RVO website. We have lot which guidance to the members, which help them in their professional matters. So kindly refer all the publications, all the ATQs. They will really help you in all the endeavors of your profession. And thank you, Saket sir, for taking this initiative. Thank you, Sumit sir. Rajan sir, I have taken 7 minutes of your time. I think you can extend your session by 7 minutes. Rashmi ma'am, Sushil sir, Drushti ma'am, and entire team of Nagpur, all the participants, thank you very much. Where you have any confusion, you can come back to us. We will be happy to answer your queries. And we are also going to circulate a study module which has been customized for the refresher course only. Thank you so much, and I forgot to thank Anil Bhandari sir and MPV sir, who are leaders of this Valuation Standards Board and taking great initiatives to move forward. Thank you so much, all of you.
Thank you so much, Sarika ma'am. It was a pleasure to listen to you and for the professionals to understand the concept. We have got an excellent speaker in the form of C. Rajan Wadhwan sir from New Delhi. Sir, I will take this liberty to take another 2 minutes for introducing your profile, because the importance gets important on that. C. Rajan sir is a graduate in commerce from the University of Delhi, and is a fellow member of the Institute of Chartered Accountants of India. He has over 25 years of professional experience on advising domestic and international clients on valuations, transactions, mergers and acquisitions, corporate and financial restructuring, purchase price allocation, business plan reviews, transaction support and modalities, finance raising, regulatory assessments, and corporate requirements of doing business in India. He has worked for a broad range of top-tier Indian and overseas clients, and has an extensive experience in the supervision of large valuation and merger and acquisition assignments across the industry segments. He has given expert testimonies on evaluation matters for disputes as well as settlements. He has an experience of working on liquidation valuation and cross-border acquisitions. He was involved in development of these valuations for standardization of valuation methodologies across PwC network. Rajan sir has served as a special invitee to the committee set up by the Government of India to frame valuation-related guidelines. He has authored the Institute of Chartered Accountants of India Technical Guide on Valuation. Estimation of future cash flows and discount rates for the purpose of impairment of assets, and articles and technical through leadership material on valuation related aspects. He was a part of the working group set up by Government of India for implementation of the Insolvency and Bankruptcy Code 2016. Friends, a man with so many feathers to his cap. We are really privileged with Wadhwan sir joining the session for guiding the members on this. I welcome you, sir, and I hand over the floor to you, sir.
Thank you, Saket. Thank you, Sarika. It's always a pleasure to come up.
Sir, sorry to intervene. Just a second, sir. I would also like to request you to share peer review. When you did the peer review, what are the findings of that peer review, so that it helps the members while they prepare their valuation report. It helps them to take caution. And also Rajan sir is a member of the committee which formulated this guidelines for caveats limitations by IBI. He was nominated by ICAI as a member there. Please also brief the members about those guidelines, sir. Both two things also please capture.
I'll do that.
Thank you, Rajan sir, and sorry.
Thank you. No issue,
Yeah.
Sarika. It's always a pleasure, and it's a great initiative, Saket, let me say, which can the other participant be put on mute, please? Thank you. So it's always a great pleasure. It's a fantastic initiative which MPV, Anil Bhandari, and others, my colleague, fellow members, have taken in terms of the valuations, educating the fellow professionals, the Sunday talks which we've been doing. They've been a great success. So it's always a pleasure to come and interact with everyone on this. What I'm going to be trying to do is I'll maybe talk a bit about the history. Sarika, while she said she's taken 7 minutes of my time, a lot of it is it may also be easing out in certain slides which I may be showing, because certain things she would have already covered. Actually, somewhere around in 2003-04, and I was a part of that committee which originally was set up by the MCA, to develop valuations, guidelines around valuations and all that. It was a Shardul Shroff committee, and it gave its recommendation. Then something around that was incorporated also in the Companies Act. At that point of time, there was a concept of registered valuer, but there was no definition. The definition was coming primarily in the form of the guidance was given that it has to be a chartered accountant who is having a professional experience of over 15 years. But IBBI from 2016-17 onwards has changed this thing, and they've come in as a regulator for registered valuer till a valuer bill gets passed at a later stage. So I will cover in this during the course of my presentation. I'll be talking about where and how does the valuation gets triggered. I'll talk about valuation myths and around valuation, do's and don'ts for valuers, and that's where I will talk about what Sarika talked about, you know, the peer review results which we found out about, or talk about the importance of caveats and guidelines around that, the caveats, limitation, and disclaimers. So pretty long this thing. I may skim through a lot of your stuff which relates. Are the slides visible?
Yes, sir. So can I make it?
Yeah, thanks. So
Can you make it full screen? Slideshow.
Just a sec, I'll do that. Is it fine?
Yes, sir.
Okay, thank you. So don't go by the number of slides, a lot of them I'll be skimming over, but the important thing is I'll talk about the valuers, the rules, the important things, the myths around valuation as a profession, and do's and don'ts. Those are the most important things on which I would like a fellow professional to focus on, because while the profession has come under the section 247, the 247 also brings in a lot of onerous responsibilities in terms of the liability which are imposed on a professional. Also, the regulator, in our case, IBBI, we all know, is a very has been following the book to its fullest, and they have been raising questions around certain valuations and how it has been done. They've been actively participating and monitoring the work which any RVO is doing, whether it's on standardization of any rules, whether it's the peer review findings and all that. So they have their people coming in even on those meetings and presentations and all that, which we do. So they are a fairly active body in that sense. So hence, I would like everyone to be careful when a person is taking on a valuation engagement. Valuation as a profession has gained importance, and I see it continuing to do so. For it, earlier, if you recollect, a valuation was prescribed under the Wealth Tax, Income Tax Act, as well as only for certain activities under the Companies Act. But now it has gone beyond in certain ways, which is like even RBI was earlier doing it, but now you've also got SEBI has come in, and they've also saying that valuations which get covered under the SEBI LODR, which is the listing and disclosure requirements, the valuation needs to be carried out by a registered valuer. So increasingly, we are seeing that registered valuer as a profession will be gaining acceptance, or a larger need for valuation to be performed by the registered valuers. So first, let me just talk about what are the sections which derive or which drive the need for a registered valuer. Under Companies Act, as like I was saying, the valuation needs to be performed by a registered valuer, a person who's a member of a recognized organization. He needs to be appointed by the board of directors. And then they are providing various rules around it. The important thing over there, which also goes into the IBBI rules, is around the person should not have a direct or an indirect asset in which he is valuing, and he should not become interested. So the conflict of interest is paramount when they're talking about it. The conditions which are also being put in place is like he should exercise due diligence while performing the function of a valuer. And then we're talking about the rules from which MCA has or IBBI has come out and placed those rules for us, which as a valuer we are required to do. And this is what I was talking about. So the nature of fines or the penalties which are imposed are quite stringent. In this case, you could also end up getting imprisoned for a year. So while the risk reward thing, one needs to match when he takes on an engagement, he should exercise adequate due diligence and professional skepticism while performing an engagement as a registered valuer. The sections under the Companies Act where a valuation by a registered valuer has already been prescribed. This is a circular issued out by IBBI, which you can take a look at. Certain sections have been prescribed. For any of those sections, a valuation now is required by a registered valuer. So which primarily relate to further issue of capital, disposal of assets, or the IE, which disposal of assets gets covered under section 177, which is appointment through a reference through an audit committee. Non-cash transactions, M&As, any purchase of minority shareholders, all these things require a valuation to be done by a registered valuer. Issue of sweat equity shares, provision of money, this thing, all I think people can refer to the circular over here. Now, what has happened, like what I was talking about, initially it was chartered accountants, then gradually now the registered valuer rule has come in. Now SEBI, and that's where we are saying originally it was with the Companies Act, where requirement of a registered valuer was required. Now, with effect from December 2020, even under SEBI, certain guidelines or certain sections under SEBI, which primarily relate to mergers and acquisition, they have said that a valuation needs to be done by a registered valuer. These are the key sections under which now a registered valuer has been recognized under the SEBI guidelines or the rules. So gradually we will see more and more authorities or regulators continuing to accept the concept of registered valuer and asking us to do valuations to be performed by a registered valuer. There are currently two primarily bodies which are not asking for a registered value valuation, i.e. one is the income tax. A lot of valuations are either by a merchant banker or a chartered accountant. The second is RBI under the FEMA guidelines is still asking for a valuation to be done by, again, by a chartered accountant or a merchant banker. But we do see all these authorities converging on it, because even in the valuation committees which have been formed by IBBI, you have representatives from these bodies over there. Now coming on to the IBC, and that's where the entire concept of a registered valuer came in, right? So over here, when the IBC was notified, it came out with this thing guideline that a resolution professional is required to appoint 2 registered valuers who will carry out the valuation in accordance with the internationally accepted valuation standards. If the difference in the value is significant, then the RP is required to even appoint a 3rd valuer, and then the closest estimate is considered. This was a big challenge which was faced by resolution by the RPs, and they did notice a wide divergence in values, and it was something which was becoming very less palatable, because they said, considering the same set of facts, same data, how can the difference be so significant or so much at variance? So there were aspects around that, and that's what resulted also in development of the guidelines around limitations, caveats, as well as standardization of certain guidance material which is coming up, like they've clearly said, defined or laid out what a report should contain and all those things around that. Well, like I said, valuation as a profession, the IBC and other things have thrown up a great opportunity, but valuation engagements, I would say, under IBC bring their own peculiar challenges, and these challenges are pretty significant, because one is a lot of these companies could be going in, are nearly on the verge of bankruptcy, right? Getting access to that information itself could be a challenge. There are certain times the records are not available. There is no one in the company who can provide you the information of the assets or the business plans or what is there. Source of information itself becomes a problem. access to the value of even being able to access, because under the IBC, you are also required to perform physical verification of assets. Even that becomes a challenge in certain cases if there is no management. How do you do that? Reliability, completeness of information, again, it's a challenge. And this was actually one of the peculiar things which at least the bankers or the creditors were saying. They said 6 months or 3 months before, 6 months before the company was referred for restructuring under IBC, we got a valuation done. And that valuation showed up a number which was phenomenally great. But now when we are getting a liquidation valuation done, the value is, say, 30% of what even the book carrying value is, but what they were not able to understand and appreciate. And that's where the basis and the premise of value becomes very important when we are carrying out a valuation, because a person should understand, is the valuation being done on a going concern basis? Is the valuation being done on a liquidation basis? Is the value being ascribed to a business or to a particular asset? So one needs to keep all those aspects in mind when a professional is performing a valuation. And that's why there was huge divergence in the values, because under the IBC, what were you trying to do? You were trying to determine the liquidation value, which is the floor price at which the committee of creditors can take judicious decisions around what they would like to do if they were to realize any funds below that value, and or should they restructure or not restructure NPA or a sticky account. So key challenges, as I was talking about, you face all these challenges around fixed asset register, inventory, data confirmation, documents, agreements, bank statements can be a challenge when you're doing any of these. Physical verification already alluded to, right? There are then these issues around a lot of these entities also have a group, a kind of a structure where there are interdependencies, right? You could have a steel company which has got a subsidiary which is only owning power, and the steel company cannot survive without the power which is coming from its subsidiary, and there are make or take arrangements inter se among the two. Now, should those two entities, when you are doing a engagement of a valuation or liquidation valuation, be looked at together, whether the resolution of that, whether the RP should look at it together when he's looking at a restructuring. Those issues become a big challenge, because and even when anyone else is performing a valuation, say of the holding company, and there's no power plant and there's a dependence on power from somewhere else, does it require any adjustment to be weighed to a value if you cannot get it from the state? Again, these are very subtle things which do come up when you are doing any valuation under the IBC for a liquidation. Then there are issues around brand, trade names and all that, whether the ownership of the brand is with the company or whose business which you are valuing. Because a number of times what you see is there are private unlisted companies which could be held by the promoters which own the brand, and then they are licensing the brand to these companies. Now, there could be issues around it, litigations around it. So someone needs to factor all those in or review all of those when he or she is carrying out a valuation under IBC. There could be fantastic assets in the form of a distribution network, right? A dealer network, but it may not capture, it may not be reflective of on the balance sheet of the entity which you are valuing, because it was a self-created dealer or distribution network. Again, who will take ownership of the cash flows which are being provided to when you carry out a valuation? There is obviously uncertainty over the life of the company. So these are certain aspects which one does need to keep in mind when he or she is performing a valuation under the IBC rules. As I said, there are around 42 RVs as on 1st of June 21 under the with IBBI. 4096 RVs registered across asset classes over here. I don't know what is the count of ICAI RVO, I think it was 800 plus. As of now, say, members, we've got the largest chunk of members in that sense. This thing. Coming on to the concept of registered valuer, and this is something what Sarika talked about earlier, is they've defined the 3 asset classes under which a person can practice. There are situations where people could or are, I am aware of, registered under 2 asset categories also. You need to take an exam, and if you clear that exam, you possess the basic qualification, you could get yourself registered under 2 asset classes. Like I can talk about engineer MBAs in finance, and they are registered under security and financial assets. Also, they could be registered by virtue of their engineering qualification under any of the plant and machinery category, or even land and building. I don't think so, but could be possibly. So that is possible. People are registered under this thing. There are 3 categories of assets as outlined by IBBI in there. This thing: securities of financial assets, plant and machinery, land and building. Here, I think I'm jumping perhaps, and I will talk about, when we issue a report as a registered valuer under IB, under the insolvency laws. Let's keep this aspect in mind. IBBI or any regulator eventually is putting the onus of the report on the person who is signing the report. We could be using another expert, who could be a specialist or who could be a registered valuer, say under plant and machinery or land and building category. I may use this report for coming out with my valuation. I should exercise due diligence at my end before I accept his report, because eventually the final report which I'm putting out is going to be signed under my name. So eventual final responsibility lies with the person who signs the report. So hence, when I talk about even the caveats, limitation and disclaimers, that's a fairly good guidelines which have been issued around that by IBBI. Please make yourself familiar with the guidelines, caveats, or guidelines or caveats which relate to even other asset classes other than securities and financial assets. Because tomorrow you are relying on the work which another professional has done, but ultimate responsibility still lies with you. So your report can be scrutinized or questioned by any regulator or any user. You as a user of the other expert's report should or can ask enough questions to get a comfort before accepting it or incorporating that in that report into your analysis. I think this is fairly clear over here for securities and financial assets. While you need to clear the exam on the other side, if you're a postgraduate in finance or a member of Chartered Account, ICA or MBA, ICMAI, company secretaries, you need to have a 3 years experience. Similarly, for the plant and machinery and land and building, it's very clearly laid out, how much experience is required and what kind of qualification which you should have over there. And then thereafter, you got to take an exam and then qualify the exam. Once you qualify the exam, then you got to get yourself registered with the authority as well as the RVO, and then become a member of, or you get your registration, and then you go through the entire process of getting a COP, and then you can become a this thing. Under the law, the relevant aspects which have been specified is you should have passed the examination within 3 years, possess relevant qualification, not a minor, not of an unsuitable mind, a person resident of India. So a person of resident in India is driven from the FEMA aspect around that. So owner's condition, I think I would like to emphasize on two things over here when they're putting in place the eligibility for a person to become a registered valuer. Not been convicted, penalty under section 271J, and the ultimate one, which is K, which he is a fit and proper person. Now, fit and proper, there is no definition per se, but they've said, they've laid out under the rules, you know, he should be a person who should fulfill the following criteria: integrity, reputation, character, absence of conviction and restraint orders, competence, and financial solvency. So these are certain aspects which are kept in mind by IBBI RVO, as well as ICAI RVO and other RVOs before even accepting membership. And they are very important. And people who are yet to take the exam for the RV, you do get questions around some of these aspects, the rules. So kindly familiarize yourself from that. As I talked about, you know, this is basically talking about more about the entity. If you're becoming a partner or this thing, or a corporate entities are also are eligible, and there are conditions around them that how can they become eligible to be registered as a RV, and then the work can be performed as an RV by that entity. So there are these guidelines around that. I'm not going to dwell over them. You can go over them on the rules. Valuation exams, again, IBBI conducts the exam. People who possess qualification and all that, they can do it. Individual can appear any number of times. You just need to pay the fees, and the level of exam, it's usually a 2-hour thing over there, around anything between 80 to 100 questions, negative marking. So one does need to do, and I can vouch for it that the course which ICAI RVO runs for preparation is very comprehensive, and perhaps has the best study material amongst any other RVOs for anyone who's yet to take the exam. He can leverage a lot upon them, that study material, and others to do it. Again, talking about the brass tacks on the rules, basically individual has to apply with an application of 5,000 rupees, partnership under Form B, 10,000 rupees, grant of certificate come in another form. So you are also allowed under the rules to shift memberships, conduct valuation of, but however, the most important thing is, like what Sarika said, is that you can only perform valuation for the asset class for which you've been registered, because even people who are registered under 2 categories, they have 2 memberships. So depending on which report are they signing, they need to mention that. So just be careful from that perspective. There are requirements of code of conduct of the RVO. ICAI RVO has got a fairly exhaustive code of conduct, which has been based upon also the code of conduct which was spelled out by IBBI, and you are required to keep the paperwork with you for 3 years plus. The important thing is, as I said, the law provides corporate entity also to be recognized or registered as a RV, partnership also. However, in case the company is a RV, besides the company, even the director who signs the report in respect of this thing, valuation engagement, he can be held responsible. Similarly, for a partnership entity, RV will be jointly and severally liable along with the partner who signs and acts in respect of valuation engagement. So these are the rules which have already been, or the conditions which have been put in place by IBBI, and one needs to be cognizant of the same. So I'm not going to dwell much upon them. I think one of the most important thing, and this is something on which when we were also carrying out or performing the peer review of the reports, certain things which get noticed or which came to our notice and are very important, which one as a registered valuer, and I'm emphasizing, the emphasis from IBBI or any other angle is a report should be self-defensible. The working paper should be there so that in case there is an issue tomorrow, they can suffice or satisfy anyone who's raising any doubts on the work which the professional has performed. So what do we talk about, and the contents of a valuation report which have been put in place, is background of and it's a must, I would say, that anyone who's doing any valuation under any of these rules, he should ensure that the report is containing these critical matters are outlined in the report. Obviously, you do need to draw a fine line when it comes to confidentiality of the client, right? What information can be put out or cannot be put out. However, you should have enough working paper which also provide enough guidance why a particular decision has been taken or a particular decision has been taken, and to justify that decision which a value has taken. You should maintain adequate papers at the back end in case any issues come up. But critical things, background of the asset being valued, what is the purpose of value and who's appointing you? These are certain very critical things, and at least in certain peer reviews, we did come across where the purpose of valuation and the appointing authority was not mentioned. So one didn't know to whom are you addressing the report to, who's relying on your report. So those are certain things I think one should focus on and be careful about. RV entity, identity of the person who has worked on the engagement, while his name or his immediate team member's name, it should be mentioned. Any other experts, if you relied on the work of another expert, another valuer who's in a different category or a class of assets, you should clearly mention that out in your report. Disclosure of RV's conflict of interest. Date of appointment, valuation report. Now, important thing about this over here is why date of appointment, valuation report. Date of appointment, does it demonstrate that did you have enough time to even perform your work? That also becomes very important. What is the valuation date? That again becomes very important because valuation is always performed at a particular point of time based on the relevant facts which have been provided to you at that point of time. The validity of the valuation report also sometimes need to be mentioned because there are a number of cases time where a valuation could be running, could come up for use. And like I said, things, even the business plan, and especially in last 2 years or 1.5 years post-COVID, the companies and everyone, the plans have been made on a rolling basis, right? 3 months, 6 months and all that. So the relevance of a valuation work which you've done or a report becomes very important, that it is important that you should outline that the report is there for X amount of time or because circumstances may change post that report. In certain cases, we have seen like regulators like RBI and others, they do prefer that the valuation date and the date of report is within a period of 3 months when a transaction is carrying out. Important other things which one should keep in mind is sources of information. What basis is this valuation being performed? Procedures which were followed or adopted while carrying out a valuation. Did you review the information which was provided to you? Did you carry out adequate analysis on that information? Those things which should be provided. So like I said, then basis of value, premise of value, any inspections or investigations which have been undertaken, especially they become very relevant if you're doing a valuation under IBC. significant assumptions, intended users of the valuation report. Intended user restriction on the use of report are again very important to protect also the professional. So long as you specify to whom you owe your duty of care and what your professional liability on that engagement is, you are much more secure. You are less susceptible to be called up or to be taken to courts by a third party, who's not intended recipient of the report. So hence, please be clear and clearly articulate in your valuation report. What is it meant for? Who is it meant for? Who has appointed you? How you've done the analysis? And please specify any restrictions on the distribution of the report, any caveats, limitation, and disclaimers, which a user of that report should be aware of when he's using a report. At the end of it, its report is the final product which you are setting out, and that's the one thing which is going to get challenged the most, and you need to defend it in any fora. Here is something which I would also mention on this is, a lot of times questions do get raised on the financial projections and how should they be disclosed, not disclosed. Now, the biggest challenge over here is, about for who you are valuing. In a number of cases, the client would not like to give out his business plans out in public domain. Similarly, even SEBI and other laws, they prohibit a company from giving forward-looking statements. The forward-looking statements can also be challenged or seen by competitors and can be misused. So hence, one needs to draw a very fine balance. I can talk about from my experience, like I've done a lot of listed company valuation, M&A swap ratios. What you give out, one is a summary report which gets parked or placed as goes to the shareholders also. There is a detailed report which is made to the independent directors, the audit committee, and everyone, which has enough workings also there. There again, a summarized set of workings also goes out to the stock exchange or SEBI when they ask it. But it is lying with those regulators, whatever they want to do with that or raise any questions or queries around it, they do it. But the report which is going out to the shareholder, it carries basic hard information on what methodologies you used, what value you reached under each valuation methodology, what weightages did you ascribe. So that summary table is mandatorily required. So hence you are finally balancing out the disclosures on one side and yet you're giving out information also. Coming on to why the need for caveats, limitations, and disclaimers. And here is something like what I said, while IBBI is a tough taskmaster, but they've also been reasonable in certain ways. They understood the importance of caveats, limitations, and disclaimers for a professional, and hence they allowed they come out with this guidelines around this. The terms can become interchangeable or used interchangeably, because what could be a limitation, say you were not able to access the management of the company or get this much information, and a valuer has outlined that in his report. A reader of the report, when he looks at it, it's also it's a limitation from the valuer side, but it's a warning or a caveat for the user. Look, this work has been done, but with the limitation of all these things. So now, should I accept it? Should I not accept it? That decision is his own, and he's aware of it. So that's why it is very important to put those caveats, limitations, and disclaimers out in your report. These things, limitation, like I said, is with respect to you. You're not getting any information or any data around it. disclaimers protects the right of an RV because it's deciding, you know, what the contents are, limits the liability of the RV also. Hence, these things are very important. Carefully go through that guidelines paper which has been brought out by BBI. Also, please familiarize yourself with even the caveats, disclaimers, or limitations which are used by the valuers of plant and machinery category, as well as the land and building category, because you could be using those their reports in your analysis, and eventually it's your responsibility finally, because you're the one who's signing off on the report. The important thing which IBBI has very clearly set out is they've understood the importance of a disclaimer, caveat, limitation. However, what they've said as a fundamental this thing is there cannot be a disclaimer which has the potential to dilute the responsibility of the RV or make the valuation unsuitable for the purpose for which the valuation is conducted. So you can't write over there, I did not get everything, and whatever information I got, or the management told me to please do this valuation in this way, I've done it. You are required to exercise your professional skepticism, your professional independent judgment of the numbers which have been provided to you while carrying out a valuation. So hence, then this thing, the D thing over here is very, very important. I think what I'm going to do is I will talk for another 15-20 minutes, and if it is fine, then I may leave around 10-15 minutes for question and answer. I think that may be a good thing for the fellow participants on this thing. You know, like I said, you know, the code of conduct clearly specifies or lays out the valuation standard compliance. So in fact, there is an affirmative statement which needs to come into the report that we followed the valuation standards, and us fellow professionals who are chartered accountants or members of ICAI RVO, ICAI RVO is already notified, you know, the valuation standard board is what is conducting this thing. So we need to give out an affirmative statement that those standards have been followed. In case you've relied on another registered valuer, you should disclose the other valuer on whom you've relied. You should obtain clarification of whatever from the RV. Like I've been saying again and again, and I'm repeating over liabilities against the valuation, irrespective of the nature of valuation or the valuation done by another expert, shall remain with the valuer who's finally signed the report which has gone. Again, we did talk about this earlier also, where we were saying that integrity and fairness and RV should maintain integrity of all professional relationship. He should ensure that they provide true and adequate information, should not misrepresent any facts, refrain from bringing disrepute to the profession, public interest foremost while performing delivering services. Professional competence and due care, we've been talking about it. You do own and you cannot disclaim liability or duty of care except to the extent the assumptions are there. At the end of it, the person who's signing off on the report as an RV is answerable for the work which he has done. It should be done with integrity. It should be done with due diligence, keeping in mind all the aspects around it. And the work should be self-defensible, as I say, and I've been repeating this word. Professional skepticism, please exercise your professional skepticism. Please exercise due diligence. Please exercise, do your work with integrity, and carefully, when you are relying on the work of another professional, kindly vet it yourself. Are you satisfied with the report which you got? if you are included into this thing. You cannot say I have relied only on the management projections, which has been given to me. You cannot get away by saying you have every right to say that I don't agree with those projections or the financial information which have been given to me. And hence I have made these adjustments. Those adjustments are justifiable. You are within your right. However, you could be required to justify those adjustments, why they made them and all that. Here, I would also say that, we are not at the end of it auditors, right? We may not have that great an access to the information when we are valuing something. So you are not required to perform an audit also on the data which has been given to you. But please perform sanity checks around that data when you're using it. I can't get away by saying someone who gave me on a Excel spreadsheet, the balance sheet, that did not tie up with the audited balance sheet. I should be at least doing this basic diligence when I'm performing a job. Again, while we talked about integrity and other aspects previously, independence and disclosure of interest is a must. You cannot get appointed for a number this thing. You should not indulge in mandate snatching or success fee mandates are anyway a no-no. If your relative, any of your relatives on the board, or you are not truly independent, you cannot take these engagements. And we do see right now what we've seen is the reports and all that as a part of the peer review are being reviewed internally at the RVO by a panel, and then the findings have been presented to the IBBI. But I don't know, Sarika may be able to talk more about it, but you can't rule out the possibility tomorrow of even IBBI conducting a review of certain valuation by their own panel of experts if they form and raising questions around separately. So it is a possibility going forward. And I'm drawing analogy from the insolvency professional. They do conduct that. They do even look at the working papers and all that stuff over there. So again, insider trading and all those rules are there. When you're performing the work as a valuer, you should not be trading in the securities and all that. Fairness and opinion, this thing, there has been a prior engagement in an unconnected transaction. Those should be disclosed under the code. Again, confidentiality is a significant or a big issue. Like I said, there are restrictions which we place even on disclosure of forward-looking reports or statements out on this thing. Information management, again, these are very important. Like I said, IBBI has clearly put out things like that. The report and your working papers should be maintained, and the papers can be produced if required to any regulator for if any of the engagement does come up for questioning. Again, independent related to independence and conflict of interest, gifts and hospitality and all those things are a no-no, and this thing relative is under this thing. So one can easily go through the rules and there'll be, you can get an overview of this. I'm just talking on the basics over here. Remuneration and costs, like I said, in a transparent manner, which are there. No success fee is not allowed on any of this. Again, rules around too much mandates. If you have, can you perform the job properly with adequate due diligence or in a fit and proper manner? Please don't accept the job. Basis the experience of insolvency professionals and all that. In case you are extremely, you're extremely uncomfortable about something which you're doing, I would, keeping in mind even the Section 247 implications, I would ask you to reconsider whatever you're doing when you're accepting a very, very high risk engagement. Can you adequately justify what you're doing? I think that should be of paramount importance when you take on any valuation engagement. Coming on to the, the talk around valuation, the myths around valuation, right? Why do they say valuation is an art and a science? I would say it's a science in certain ways, that there are methods which are prescribed, that if you adopt those methods, you can get decent results, right? Or there are only 3 methods which are laid out, right? Income approach, market approach, asset approach. And if you adopt any of these, you will come out with a valuation. It is an art. Why it's an art? Because judgment or how you're applying those methods becomes very important, and that is what impacts or influences your results. Hence, valuation is both an art and a science. It's like I say, a DCF or an income approach is as good as the analysis which has been performed on the information which has been performed to you. Similar stuff holds true for market multiples. Similar approach thing holds true for your asset valuation also. Suppose you have a situation where a company is only been growing at 3% year on year, but you're getting projections which are showing 20%, 40% growth year after year there for next 5 years. Now, unless and until you exercise your professional skepticism, get into the detail of it and analyze it, is it possible? Is it not possible? The results, if you blindly accept what has been given to you, could be hugely erroneous, and you could be running into a problem. So that is where the exercise of judgment becomes very, very critical when you're performing any valuation assignment. And a value can, while in certain cases we are required to give a single point reference of value, a value cannot be very precise. It's like you are planning to buy a house, right? You go out, you take a look at it, someone else may put, the valuation is typically in a range. That's what we say. And you could be within 5–10%, but using the same set of facts and same data, the two valuation should be in a fairly comfortable range of each other. It cannot be that one is at 100, the other is at 10,000. Then if your results are coming like that, there is an error in your analysis or something of that sort. So it's only when it comes to under a RBI where they want a single point reference, where you're doing a valuation under Income Tax Act, which is a rule or a formula based approach, that you can come up with a very precise answer. So typically valuers present their results in a range, and they may take a midpoint as a reference point, a high point or a low point, depending on the need and all that. But the range is also usually kept around 10% or nothing beyond that. People don't go into looking at 20–25% variation in the range. Those are not there. Valuation is always subjective. I don't think so. The methodologies are pretty well laid out. When you follow those methodologies, you exercise your judgment around the various aspects which influence the methodology, and you will come out with this thing. The rules of thumb are accurate to value a business. Again, that may have held true sometime back, but not now. Let's take the case of all these startups, right? On one side, you've got entities like there's a famous thing going around, right, about major hotels, major restaurants. Their combined market cap is less than the market cap of a Zomato right now, and those are proven businesses which have been making money. Over here on the other side, you've got a business which is still a cash guzzler. It is a delivery based thing, and living on, but it's a marketplace and it's got a stranglehold. So tomorrow, how it changes or what it does it could be driving the value. this thing, but I'm not going to get into the valuation of Zomato or anything right now. Other thing which I talked about is valuation is timeless. I don't think valuation is timeless. Valuation is at a particular point of time. It may hold true for a particular period of time at best. You should keep in mind the factors are the same when you're signing off on the valuation report.
हेलो मैं अभी व्यू कर रहा हूँ, थोड़ा रिकॉर्डिंग है ना, आवाज बराबर जोर से नहीं आते.
Yeah, so one should keep in mind that aspect, because there are a number of cases, right? I might do a valuation of 1st of April 2021. Come 31st May, there is a earthquake in a particular thing, or there are floods and the plant gets destroyed, or the manufacturing facilities got flooded. It has been out of operations for 1 month, and I'm then doing a signing off or completing my engagement, say on 31st July. Now I should factor in the relevant facts which like this closure of this plant or a destruction of this plant into my analysis when I put up. Even the valuation date is kept as 1st of April 2021. So one should keep those things in mind. Valuation is complicated. Yes, it is complicated as well as simple, I would say. I've been doing it for 25 years. I enjoy doing it. It's complicated yet simple, I would say. Value of a business is based only on its financial attributes. Again, no. I would clearly say that. Let's take an example. There could be 4 companies, or there could be 10 companies in a particular space, but each of them could be attracting, could be valued in a different way, or the market may be giving them a different value. Why? Because of certain factors around that company, which could be in terms of transparency, professional management, growth potential, and those certain intangibles which can influence this thing. You've always seen company which has got a scale and a size could attract a higher valuation vis-a-vis a smaller one. But then we could also have a small niche player whose growth is on a different trajectory, being valued on a different plane vis-a-vis an established player. So I won't say that valuation is based only on financial attributes. There are other softer aspects which do come into play, reputation of the management, investor awareness, how actively they interact with the investors. A lot of things make a lot of difference. What are the processes or procedures, credibility of the management, all those things which are softer in attribute beside the numbers do influence valuation. There are 100 of models to carry out a valuation. Well, there are no 100 of models, but there could be many scenarios to perform a valuation, but there are not many models. Financial model would remain the same. The base model could be remaining the same. It's only the underlying, assumptions which you may change and come up with this thing. However, it is under various assumptions, the value could be totally different. So what we call, there's another thing called, value enhancement, or a lot of clients do come to me in terms of how can I improve value of my company. And then you could be doing, you're not issuing out a valuation report as a valuer, but what you could be doing is you could be doing as a consulting engagement, you could be doing, I will do an analysis of the key factors which influence your business. I will take a look at you, benchmark you. And now if I improve upon any of these 8 or 10 factors, what impact that may have on your value is what I could give out. And that's something, it's called value creation. It can be a simple thing like I do a benchmarking of a company X, which I'm valuing against the industry peers on, say, on a working capital, or if I was to change your cost of capital, what impact that may have on your value is something which I could be doing as a part of a consulting engagement where I'm not giving out a valuation. One of a very good, fantastic case which does come to my mind was in early 2000 or late 90s. It's around Hindustan Lever, if you recollect, and if any one of you has been a shareholder of that company. The company was a zero debt company, right? So invariably, whenever a valuation of that company used to get carried out, it used to be the discounting used to happen at the cost of equity because it was a zero debt company. So what they said was, we don't need money. So what do? So they issued out debentures to the shareholders, right? They paid tax and everything on it, but it did not result in actual cash outflow, but they were all able to alter the cost of capital mix by getting this debt also in it, because on the debt, you are also getting a tax break on the interest cost and all that. And that lowered their cost of debt, and that result positively flowed into their valuations going forward. Valuation of a business is same irrespective of the valuation approach. See, the relevance of the approach is very critical when you're performing a valuation. There are a number of businesses which get valued using a DCF. There can be certain businesses, the conclusion which you may arrive using a DCF or an income and a market multiple. At the end of it, we always say that you should adopt multiple methods of valuation and try to triangulate your analysis or results and see that they are in close proximity to each other. However, there can be certain cases where only one approach may be relevant and the other one may not be relevant at all, or you may not be able to adopt it. It can be in the form of a land or an asset holding company, right? Over there, you may not be able to apply a market-based or a market approach because land track at a particular place could be totally different from a land somewhere else. So one does need to keep those aspects in mind. And however, the most important thing is, and this is something again which has come up as a part of our peer review whenever we've been reviewing the reports, is why a methodology has been used and why a particular methodology has been discarded should be clearly articulated in the report. Suppose you're not able to apply a market approach, you should emphasize why you're not able to apply a market approach or why you're not able to apply an income approach. Please specify that out clearly in your report. This is something, one of the findings which we did come across, people were not justifying properly why they had not applied another. I came across a situation where someone said he's not considered the share price or the market price of a listed company's shares because it entails something else. How can you disregard that from your analysis? So you should keep that in mind. Valuation of the business is same irrespective of the valuation approach. Yes and no. You do need to keep the aspects around it. Like I can give you another example over here. Let's take you're valuing the hospital, or hospitals tend to get valued also using an approach what we call a multiple to a bed ratio, and it becomes very relevant when you're trying to adopt that approach. Please also keep in mind the bed cost could remain same for the building or the infrastructure piece of it, but the cost of land where the hospital is situated can make a lot of difference in the value of two assets which you're comparing. At the end of it, you should not end up comparing apples with oranges. So try to gather data which gives you a perspective, or gives you enough comfort that you are doing the valuation in the right manner, and you are comparing the right or your comparable set is relatively same. So that's where, like I said, science and an art, the judgment piece does come into play over here. You do need to see that outliers are taken out, or what is the closest one which I can use. So those are certain things. Complex valuation do not yield better estimate of value. Well, I can't say that. At least when you're doing ESOPs and you're trying to do various scenarios, Monte Carlo simulation models and all that, they do give you much more analysis or perhaps much more data points to take a informed decision. Cash burning startup companies, I think I was just talking about Zomato. There have been enough cases around Flipkart and others, right, where the companies are still making, are still incurring losses, but their valuations have only gone up and up and up. While they did take a downturn also in between, around 4 or 5 years back, but then now again they're up. So obviously the factors which are influencing your analysis or the business which you're valuing, you do need to look at it from the parameters of what is the growth potential, how the peers are faring, where they are, how much time do you think, where this particular entity could be, can it reach a position of dominance somewhere down the line. Those are certain factors which one does need to keep in mind, but like I said, valuation is always at a particular point of time. Today, technology is one of the favorites, right? People are willing to give a lot of value to tech companies, tech startups, and they do think that we are undergoing a revolution, I would say, in certain form, that they are willing to ascribe a higher value and yet wait for those companies to turn around. However, what I would also like to say is, please do not compare cash burning startup companies in the same manner as, say, a GameStop or any of those companies, because those valuations ramp up in those valuations in US and all that happened because of an arbitrage situation also, that unlike in India, over there there are no limits on short selling and all that, and smart analysts could analyze or could identify using algorithms that the people have oversold the stock, so they bought the shares and the short sellers were caught unawares. So that's something different. That's got nothing to do with the valuation, but I'm just saying a cash burning startup could be different from a GameStop scenario. So just be careful about that. Important thing which one should keep in mind is the difference between price and value. Price is what you pay to acquire an asset. Value is something inherent to that asset. There could be various motives which could influence the price. The price comes into play basis the negotiation of ability of the buyer, seller, willingness, and other factors coming into mind. You could end up paying even a higher price, keeping in mind some synergy benefits which you think you can get by doing an acquisition. So hence, it is very important to keep in mind the difference between price and value. Valuation should be done only when business is ready to be sold. Well, I don't agree with it because I told you we are seeing a lot of these cases where people want to know how can they create value for their various stakeholders, and they don't want a valuation report. What they're saying is, what are the key factors which influence the value of my business or my entity which I am running? Can you tell me what changes do I make on any of those factors and what impact it could have on my value? So those are certain interesting things which are happening in this space going forward, and especially these value creation aspects are gaining more and more momentum now as we see promoter shareholdings coming down and more professional or private equity ownership of assets happening, because their whole intent is to try to maximize the value, and they would like to, what all they can do to maximize the value is what they're more interested in this thing. Coming on to this thing is do's and don'ts for valuers. I've been talking a lot around it across the previous slides, but some of the important things is which one does need to keep in mind. You do need to comply with valuation standards, which my fellow speakers will be taking you through with over the next few days. You do need to comply with the regulatory provisions. You should be independent. Identify potential conflict of interest situation while performing evaluation. Be clear about understanding of what is the asset which you're valuing, the purpose of valuation, users of valuation report, date of valuation report. Please keep these aspects in mind, while keeping in mind what minimal disclosure you should have in your valuation report. That will come in very handy for you. Possible sources of information. Another important thing is please articulate or draft your engagement letter well. Get a management representation prior to signing off on the final report. Do keep all those aspects in mind. Assess management, the information which has been provided to you by the management for its reasonableness, and analyzing it against the past. What is happening in the industry, what is the forecast and all that. Please vet that or carry out an analysis that all of that is gelling, because the story to justify valuation should be very good or be self-defensible in terms of this thing. What I have also noticed in my experience is, in case any valuation comes up for any scrutiny, now that may happen a couple of years down later from the time when you would have done it, and the person who's looking at it, then he's got the benefit of hindsight also. He's seen the actuals also, but he's not realizing when you would have done the valuation at that point of time, that was the information which is available to you, and you did it on the basis of the overall environment at that point of time, and hence these are certain things. Just be careful, keep in mind, otherwise it's like I said, you will enjoy doing the valuations per se. It's stimulating, it's challenging, it's interesting. You get to know about much more businesses and what are the drivers of value in that sense. I think I'm reaching close to the talking time. Like I said, I've already spoken about caveats, limitation, disclaimers. Please look at them. Conclusion should be unbiased, fair, and all that. Possible valuation methodologies have been followed. What methodology and approach you've not adopted, please justify why you've not adopted it, or put a line around that. With this, this is again something, a no-no, which you should do is the purpose of valuation. Again, we said relying blindly on management, because I've seen certain reports we did come across where someone even put in a line like, I've been asked to discount these cash flows at X rate by the management. Then what was the purpose of you being engaged? I don't know. So hence, carefully analyze all that. Market data, I said, another expert, if you're relying on it, please be careful about it. Do exercise your own due diligence on the work. Do question that work the way your work can get questioned. At the end of it, you are a user of that report, right? Not physically verifying tangible assets in a liquidation valuation is a don't. You are required to do it. Financial assurance on financial forecast. Again, like I said, you cannot guarantee that. What you need to say is that you performed adequate work on it to say they look reasonable to you. Contingent fee is a no-no. Caveats, disclaimer, limitation, I've been saying they should be there in your report. Concluding on valuation, wide range is observed. Again, like over here, I would like you to carefully, any methodology which you adopt for any valuation, you should eventually come to results which are in proximity to each other. And otherwise, you are missing out on something or the other. And hence, it is important that when you are seeing divergent or hugely diverse values, you try to analyze the reasons why this is happening, and then go beyond that and see where under which methodologies there's an issue, because it is not possible that the results can be at using the same data set, same facts, whether the appropriateness of the approach with what you are adopting, how you are adopting is right or wrong, should be kept in mind over there. So please triangulate your results, use all the approaches to further strengthen your valuation which you've done. Thank you. Now I'm open to questions for next 5-7 minutes, if that works for anything. Saket, yeah. the floor, can someone open up the floor, and if there are any questions, we can do that.
I will request Sarika to please take up the question and answer session, which she will make it more clear for the participants. Sarika ma'am.
Yes, sir.
The queries, ma'am, please.
If there are any, I have already replied to the queries raised through chat box, sir.
So we can keep the session open for if anybody wishes to ask any question, they can unmute themselves and ask the question right now. This is the benefit of this technology, that we can raise our queries directly on that. So I request all the participants to please raise your queries directly by unmuting yourself.
Good morning, members. Dinesh Chawla here, a member from Chennai. I'm not a registered valuer yet, but wanted a small clarification in terms of transfer of shares when it happens between two shareholders of an unlisted company, because over listed company, it can happen through a stock exchange, whereas through an unlisted company, it will be between the private participants. There are no valuation report requirements under the Companies Act. So is there any other provision where a valuation report is mandated? I understand it is there for the income tax, that on a guidance level, but is there any other urgent requirement in terms of those valuation reports, sir? So that would be my question.
There's nothing under the Companies Act which is required because it's a transaction between the two shareholders. But you will require it for the Companies Act purposes, or if it's a foreign shareholder, you could also be requiring it, for income tax, you could also be requiring it for FEMA purposes.
Okay. Thank you. So under those, so when we are telling about the reports, valuation reports, when we are telling that the purpose should be mentioned, so can a valuer issue, not a registered valuer per se, but under this scenario, under income tax and under RBI, so a valuer has to issue two separate reports, one for the purpose of consumption for RBI and one for the purpose of consumption under income tax.
Again, up to you. You can issue a joint report which can be filed with both the regulators, or it can also be done with the. I ideally prefer issuing out two reports, because sometimes what happens is, like what you're giving out to the RBI, again a single point reference, and over there they're also talking about the methodology. The valuation should be performed under any international valuation standards. That's what RBI says. And under the Income Tax Act, depending on what purpose you're doing the valuation, or how, because the private company, you could also be using the asset base rule 11 UA or 9B, any of those ones, which is a formula driven valuation, right? So if you're doing any of the valuation under that section, then you may look at issuing out a different report. Again,
can there be like a little different value in both of those two reports based on the...
Like I said, if you're adopting the income tax one, which is the formula one, where they ask you to replace the value of either the investments or the assets, which is land and building with the circle rate and all that, that value obviously is going to be different from a valuation which you've done for RBI, which could be using a normal discounted cash flow, because you're not looking at any future financial projections at all. Again, like I said, it depends on the applicability of which section is coming into play, because there can also be a fresh issue of shares, for which again 56 and all those things come into play for tax purposes.
Yes, sir. Yes, sir. One more continuing question on this, sir. In terms of the projections which are shared by the management, right? When we assess or evaluate those projections, and when we are not certifying the financial forecast, or we are not providing any assurance from that side, will it be reasonable enough for us to adjust those projections subject to the market factors and economic factors available, and then provide a valuation based on those adjusted numbers?
See, at the end of it, let's be clear on one thing. A valuer cannot make his own projections or develop his own projection, because then it becomes the self-attest kind of a thing, right? So
Right.
first is, as a base, we need to get the information from the management on this, the valuation, this thing, right? Then what you've got is you analyze it properly. Are you comfortable with it, or do you think that certain changes should be there, or it should be relevant over there? Then you analyze that data with the historical, with the overall economic, this thing, in the future achievability of all that. And then you make your own judgment. What you may do over there is, I will not change the projections, but I may adjust the risk or the discount factor around that. Okay. And then conclude on a value. So those are certain things which are open to you, and that's within your realm, where you think even the terminal growth rate, you may like to put a different number.
One more continuing question, sir, if I am allowed to ask. When we are adjusting it through the discount rate and other factors like adjustment to a terminal growth by justifying the additional risk for the company, can we allocate it under the liquidity discount, or it has to be under some other parameter?
Sorry, liquidity discount and all that is beyond the projections are different from the liquidity and all those other factors, or minority discounts and all that.
Okay. So how do we capture that, or it will be only by way of a beta adjustment, or how will that work
you
out?
put an alpha or a beta around the additional discount, this thing, into the CSRP, which is the company specific premium. And when you're going later into the minority discount and all that, you come out with the overall value of the equity, and then you make adjustments for illiquidity and all that.
Okay. Thank you.
Hello. 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 I have a question. Am I audible?
Yeah.
Yeah, sir, I had a question on the methodology. If I am evaluating valuation under three methodologies, let's say NAV, DCF, and market multiple, and I am getting three different values, then is it like that I have to take the highest value for the, I have to finalize the highest value which comes up?
No, I don't go with that logic. The way I do it is I would do the valuations using all these 2 or 3 approaches, right? And then I might, and if my results are going at a vast difference, or there's a huge divergence in my results, what I would do is I would recheck where am I going wrong.
Okay.
And then I would come to this thing, if I'm able to identify the fact and I'm able to reach this thing that my ranges become narrower, then I may ascribe weights to both the approaches or 3 approaches, and then come to a value.
Okay. And in case if there is not much difference, then are we okay to opt any method?
No, I would. If your results are in close proximity, I would still suggest you to pick up perhaps the highest and the lowest as your range of value, right?
Okay. And one more question. Can a DCF?
We have separate sessions for all these questions. If you have any question related to this session, I would request you to kindly ask. Other sessions are also planned for specific questions.
Fine, ma'am. Thank you.
Okay.
Thank you, sir.
Yeah. And also go through the ATQs, because there are questions which have been raised in the webinar or VCMs organized by us. We have given the backgrounds. We have given the answers to all probable questions. So these are participants' questions answered by us. So it will really help you to understand things better.
Okay, I think let's call it for the next this thing. Speaker, Saket, is that okay?
So I feel we have got 3 more days to go, and we have got on that. So for today, we can wind up on the session for today.
Sir, only one thing. Members are having questions on registration for educational course conducted by ICAI RVO. As already informed through chat, please send mail at rvocourse@ici.in. Batch is already going on. There are no chances to get registration for this batch. Next month, when the batch will be launched, once you send mail ID, we will send a separate mail to all of you. You can register within the given time. So the process, everything will be given in the mail. Kindly go through the mail in detail, and you can register all the documents, what are the details required are you will find there in the back in that form itself, Form A. Okay. So once send the mail at rvocourse@ici.in that I am interested in taking the batch. Once the batch is launched, you will be informed, and then you can register for the batch once it is launched. So thank you for this 4-day session. If 40 participants have also registered for 8 to 11, this is commendable, sir. This is for learning. People have really joined. So I would also hope Sumit Dadaji is also here. So if faculties are also attending the courses, this is such a nice gesture, and they have this gist of learning.
And also on a working day, sir.
On a working day, matlab morning 8 to 11, he's been thoroughly here. This is, thank you so much, sir. Thank you so much. Yeah.
So
sir, over to you.
Hats off to all the participants for getting up so early in the morning and having that learning curve. We are extremely thankful to Rajan sir for his effective deliberations, the do's and don'ts, the myths. So these are always going to continue. I feel these types of sessions should be continued, because after a moment of time, we again go into that myths. We again to revise that do's and don'ts. So extremely informative session. Thank you so much, sir. I thank all the participants for the patience as well, and Sarika ma'am for taking up the queries of the participants. We are calling it off for the day, and I request everybody to please join for the session tomorrow at 8 a.m. sharp in the morning. So with the speakers, C. Drishti Desai and C. Parag Ved, they're going to speak on Parag Ved on valuation approaches and methods vis-a-vis ICAI Valuation Standards 103. And Drishti Desai ma'am is going to speak on asset valuation procedure and practical insight. She's going to speak about 301, 302 and 303. So I feel there is much in store for everybody tomorrow. So I wish everybody a very happy Tuesday. May you be happy and safe at all points of time. As I end this session, thank you and thank you all.